All right, we're going to continue our NOCTI preparation today. This is lecture number 2. Just to recap a little bit from yesterday. Yesterday we talked about accounting principles, primarily accounting ethics. And we talked about these 3 things. We talked about confidentiality, making sure that we keep private information private, because as accountants we're privy to a lot of information about individuals and other businesses, and we need to maintain confidentiality or keeping that information private. Second, conflict of interest. We should avoid situations where our personal interests conflict with our professional duties. And so that could even be a conflict that appears to be a conflict. It doesn't even have to actually be a conflict, but it has an appearance of a conflict. We should avoid those situations. And then finally, integrity, making sure that we do the right thing, even if it comes at a cost, personal cost to us, but also when it doesn't seem like anyone's going to know or find out about it, we still want to uphold a high level of integrity. And these are all things that we answer to our industry, not just the company that we work for. So this goes above and beyond what maybe our company policy says that we need to do. And then we talked about the accounting cycle, steps 1 through 8. Some textbooks will have more steps, some textbooks will have less steps, but at the end of the day, you need to have some understanding of the steps of the accounting cycle, starting with analyzing the source documents. Once we understand the debit and credit parts of that entry, because we're going to be using double entry accounting, which basically says that there has to be a debit and credit part to every entry, so at least 2 accounts are affected in order to keep the accounting equation in balance. We'll journalize that transaction into the appropriate journal, whether it be the general journal, cash receipts journal, cash payments journal, the purchases journal, sales journal, and I think that's the only journals that we introduced in this text. But then we post it to the ledger, and once we've posted to the ledger for that period, then we're ready to prepare our worksheet. And our worksheet, remember, is just a piece of scratch paper. It's not a permanent part of the business documents. And we have our trial balance, and the primary purpose of the trial balance is to make sure that our debits equal our credits. If they don't, then we need to go back to our journal entries and our general ledger and figure out where the error occurred and make that correction before we continue. Well, once we've done that, then we're ready to prepare our adjusting journal entries. Remember, adjusting journal entries are to help us follow GAAP, or generally accepted accounting principles, which basically say that we have to use accrual accounting. And accrual accounting is recognizing revenue when it's earned and expenses when they're incurred, rather than when cash just changes hands. And so we follow accrual accounting, and because of that reason, we have to do our adjusting journal entries to make sure that our assets and our expenses and our liabilities are all updated to show an accurate financial picture of where our business is before we prepare our financial statements in step 6. And our financial statements, which we'll talk about in more detail today, are our income statement, our balance sheet, our statement of stockholders' equity, and our statement of cash flows, or our cash flow statement. Remember, the cash flow statement is the only financial statement that uses the cash basis of accounting. Then we're ready for our closing entries, and we'll zoom in a little bit more on our closing entries today while we're talking. We have 4 general closing entries that we need to make in order to close out our temporary accounts and set ourselves up for the next accounting cycle or accounting period. And step 8, we prepare the post-closing trial balance, which just captures our permanent accounts, so our assets, liabilities, and equity accounts will be captured on the post-closing trial balance. And again, we want to make sure, like we did with the trial balance on the worksheet, that our debits equal our credits going forward to the next period. And then once we started the new period, there may be some accruals that we need to reverse, some reversing journal entries at the beginning of the next period. So keep that in mind too. Remember, that was primarily dealing with interest revenue or interest expense that we have not yet paid or received, and we will in the future period. So we want to reverse those adjusting journal entries that we made in order to close out the prior period, to recognize that accrued interest during that period of time. We want to reverse it out so that when we do receive the cash and we make the journal entry, we won't be overstating our revenue or our expenses in terms of interest. And then we talked briefly about these depreciation methods, LIFO, FIFO, weighted average, and the lower of cost or market. We also talked briefly about these accounting equations that should stay true. And we'll talk more about this tomorrow when we talk about financial ratios. But revenue minus cost of goods sold equals our gross profit when you're dealing with a manufacturing business. And then your gross profit minus your operating income equals your net income. So today what we're going to do, we're going to focus on these closing entries. And then we're going to talk about the 4 major financial statements. All right, and so the whole purpose of closing entries is to reset our nominal accounts, or AKA our temporary accounts, back to 0 at the end of the accounting period so they're ready for the next accounting period. And so yesterday we talked briefly about these 4 different closing entries, and so I just want to zoom in on those 4 closing entries today and talk about them in a little bit more detail. And so when you're dealing with a corporation, these closing entries are generally the same, but they're going to be slightly different than when you're dealing with a sole proprietorship. And we've gone through the full accounting cycle for both a sole proprietorship and for a corporation that operated a manufacturing company. And so you guys are semi-familiar with these closing journal entries, but just to recap them in a little bit more detail, first we want to close our revenue accounts, right? So first we want to close our revenue accounts, and that's what we have here is close our revenue accounts to income summary. And so when we close our revenue accounts to income summary, our revenue accounts are going to have normal credit balances, and so in order to close those revenue accounts, we're going to need to credit income summary because we'll be debiting those revenue accounts. So our first closing entry is going to be a credit to income summary. And then our second closing entry, now before we go forward, I want to make sure that we understand that there is more than likely, especially with a manufacturing business, already going to be a balance in the income summary account. And what is that going to be from? Does anybody remember? The merchandise inventory adjustment. So the adjusting entry for merchandise inventory is going to be in the income summary account at this point. Now, if it's a debit balance that's in the income summary, that would indicate to us that during the period, during our adjusting journal entries, we would have decreased merchandise inventory. If income summary starts out with a credit balance, that would indicate to us that merchandise inventory increased during the period, and that's why income summary is starting out with a credit balance. All right, so our first closing entry is going to close the revenue accounts to income summary. So when you're looking at the adjusted trial balance, so if you're imagining the adjusted trial balance, and so this is after closing entries have been made, you're going to have a debit side and you're going to have a credit side. And you're going to have all of your permanent accounts are going to be above income summary. All right, so all of the accounts that are above income summary are going to be your permanent accounts. That's terrible, but hopefully you heard me say it. Permanent accounts. And so that's your assets, liabilities, and equity accounts. They're going to be above income summary. Everything below income summary is going to be your temporary accounts. These are the accounts that need to be closed and set back to 0 before we go on to the next period. These temporary accounts are your revenue and your expense accounts. All right, so anything under income summary that has a credit balance is going to be part of your first closing journal entry. Your first closing journal entry is going to set all of these accounts that have normal credit balances or credit balances on your adjusting journal entry, they're going to set them back to zero, and that's your first closing entry. So you would be debiting these accounts and crediting income summary for the sum of these accounts in order to close them and set them back to zero. Your second closing entry is going to close out all of your temporary expense accounts. So your second closing journal entry is going to close out all of the accounts under income summary that have a normal debit balance, and they're going to set them back to zero. So in order to close these that have debit balances, you're going to need to credit those accounts. And so by crediting those accounts, then you're going to debit the sum of those accounts to income summary. So this is going to be the sum of your expense accounts getting close to income summary. And then your third closing journal entry is going to figure out, hey, what's the balance of my income summary account? And based on the balance of your income summary account at that point, you want to set this back to zero. So if the debit side is heavier and you have a debit balance for income summary, in order to set it to zero, you're going to need to credit it. And what that would also indicate to you, if you have a debit balance in your income summary account after your first two closing entries, is that you had a net loss during the period. Okay? It's going to indicate that you had a net loss during the period because you're going to be debiting retained earnings and crediting income summary to close it. Now here, if you end up with a credit balance in income summary after the first two closing journal entries, that's going to indicate to you that you had net income during the period, because in order to close the income summary with a credit balance, you're going to need to debit income summary, and then you'll be crediting retained earnings. Okay? And so the third journal entry here is going to close income summary to retained earnings. And again, if you have a credit balance in income summary at this point after the first two closing journal entries, that indicates to you that you had net income. If you have a debit balance after these first two closing journal entries, that would indicate to you that you had a net loss. All right, so if a debit balance, that would indicate that you have a net loss. If a credit balance, that would indicate to you that you have a net income for the period. Because essentially what this is showing is your revenue minus your expenses. All right, and then your fourth and final journal entry is going to be to close the dividends account to retained earnings. Now that's talking about a corporation and closing the corporation's books. But if this was dealing with a sole proprietorship, you would be closing the owner's drawing account to the owner's capital account. And here, you'd be closing retained earnings to the owner's capital account if it was a sole proprietorship. All right, so that just zooms in on closing journal entries for you, and the four closing journal entries. So close revenue, close expenses, close income summary, and close dividends. All right, so I don't know how you remember things, but I don't know if you could make something up with, close revenue, close expenses, close income summary, and close dividends. Is that how you spell read? Like, the person's name? I think maybe. So maybe you could remember, if you're dealing with a corporation and you're doing closing entries, remember Reed is your guy. Reed's the dude with the big, thick glasses. He's the one that does closing. Hey guys, are you done with your adjusting journal entries? It's time for me to do the closing journal entries, and so I need to know that you guys are ready for closing. So Reed is the guy that's going to do the closing for the corporation. So just remember, Reed, he's going to close the revenue, expenses, income summary, and then he's going to close dividends. And so he's ready with his calculator to do closing entries, okay? So however it is that you need to remember closing journal entries there. If you're dealing with a sole proprietorship, you're closing revenue, you're closing expenses, you're closing income summary, and then you're closing the owner's drawing account. So Reed can handle that too, right? You just got to remember, you know, if it's a corporation, you're closing dividends. If it's a sole proprietorship, you're closing drawing, right? And so Reed handles closing. Hey, there you go. Reed is the dude for closing journal entries. All right, so then once we've done our closing journal entries, and this part of our closing journal entries is done, then it's time for our post-closing trial balance. And our post-closing trial balance is going to have, remember, only our permanent accounts. So only our permanent accounts are going to be left for our post-closing trial balance. And the post-closing trial balance, again, we want to make sure that our debits equal our credits on our post-closing trial balance. So now I'm going to talk really quickly about our four financial statements. And thankfully, we were able to look at the cash flow statement most recently. And I'm hoping that some of that sticks with you and that you review that section of the text as well, so you'll be prepared for NOCTI. But our first our first financial statement that we prepare usually is our income statement. And so remember, the income statement covers a period of time, right? And so our income statement is going to show our profitability, all right? So income statement is going to show a company's profitability over a period of time. And that's why it's going to say for period ended before it says the date at the top of the income statement, all right? And then we have our balance sheet, all right? You have your balance sheet. And remember, your balance sheet is a snapshot in time. It's just a moment in time. So your balance sheet is only right for that moment of time. So if you have a balance sheet that says January 26 and now it's January 31, you cannot rely on that January 26 balance sheet to still be accurate. Remember, because the balance sheet is a period of time. It's a snapshot, a moment in time. It's just right for the time that it was prepared, okay? And the balance sheet is going to show us our financial position for a period of time. And that financial position basically showing, hey, assets, liabilities, equity, where do we stand? Obviously, we want to have more assets than we do have liabilities so that we can have some equity. If our liabilities are heavy, then we're on our way out of business unless we got something big that's about to pop off and we just had liabilities for R&D, pharmaceutical industry. I could make a political statement there, but I'm just going to let that one pass. All right, statement of cash flows. That's our most recent financial statement that we looked at in chapter 21 or 22. And so this one is important because it is the only one that uses the cash basis of accounting. And this is going to show how our cash is flowing in and out of our business. And so it's going to show cash inflows and outflows during a period of time. And so remember, with the statement of cash flows, there was three sections. We had our operating cash flows, we had our financing or investing cash flows, and we had our financing cash flows. So inflows and outflows of cash. And this is summarized on page 692 of your text, okay? So when you're studying, refer to page 692, and there's a chart on page 692 that's really helpful to summarizing these three different parts of the statement of cash flows and what falls into them. Remember, our operating activities are our day-to-day business activities, so our sales and our expenses. That's sales revenue is going to show inflows of cash, and expenses related to operating our business, keeping our lights on, etc., paying our employees, those are going to show outflows of cash. in our operating activities, our day-to-day business activities. We want to have a positive cash flow in our operating activities because that shows that our day-to-day operations are profitable. If they're not, then we need to figure out why not and shore that up. All right, and second, we have our investing activities. And our investing activities, for our purposes, they primarily captured the buying and selling of long-term assets. Okay, so our investing activities, they primarily captured the buying and selling of long-term assets. So long-term assets are typically purchased with the thought that they're going to help us generate revenue in our operating day-to-day business activities, right? If we sell those long-term assets, it's usually because we're getting ready to purchase some updated equipment, or for whatever reason, maybe we're shifting our business operations to something different. And so a purchase of an asset is going to be an outflow of cash under our investing activities. If we're selling a long-term asset, we're selling a piece of equipment, that's going to be an inflow of cash under investing activities. So don't accidentally assume that things that sound like investing activities are investing activities, all right? So for example, the purchase or sale of stocks and bonds. It sounds like investing activities, but for the statement of cash flow, it's not. It's financing activities, okay? And so financing activities are loans, issuing stock, paying dividends, all right? So these are, hey, how are we raising capital and how are we paying for the ways that we raised capital? And so remember, there's two primary ways that a company or corporation can raise capital. One is through debt financing. So that's borrowing money that we're going to have to pay back with interest, right? Or it could be equity financing. And that's where we sell parts of our company. We don't ever have to pay anybody back for it. We sell parts of our company and now somebody owns a piece of the pie. So we're going to have to potentially share the wealth with them through dividends. So issuing stocks, paying dividends, issuing bonds, all of those things are going to fall into the financing activities. And again, this is all summarized really well in a chart on page 269 of the text. 692 of the text, okay? So if you can commit that chart to memory, you'll be in good shape for the cash flow statement and those multiple choice questions that will show up about the cash flow statement on the NOCTI exam. Now the fourth statement is the statement of the statement of stockholders' equity. And the statement of stockholders' equity, all it does is zoom into your balance sheet equity section. All right, so your statement of retained earnings, or your statement of owner's equity, your statement of stockholders' equity, it zooms in on the changes that happen in the equity section of the balance sheet. So typically, you've prepared this statement of cash flows, and it informs what is going to appear on your balance sheet under the equity section to make sure that everything's updated. And that's going to include your beginning equity, so your retained earnings is going to show your net income or your net loss and how that changes your retained earnings. It's going to show any dividends or withdrawals, okay, so any payments to shareholders or any withdrawals by an owner in sole proprietorship. And then it's going to show your ending retained earnings, and your ending retained earnings that are reported on your statement of stockholders' equity is what's going to show up as a bulk number on your balance sheet. So if you see the retained earnings on the balance sheet, you want more detail on how they got there, you go to the statement of stockholders' equity, because the statement of stockholders' equity is going to show the changes to that section during the period that you're reporting. All right, so again, the four financial statements that you need to know: income statement, that's going to show profitability over time. Your balance sheet, it's going to show a snapshot of your financial position. Your statement of cash flows is going to show cash generation and usage. And remember, refer to page 692 of your text for more detail on that. And then for your statement of retained earnings or equity, it shows changes to your ownership equity. Closing entries help reset your temporary accounts, also known as nominal accounts, before the next period. And your post-closing trial balance ensures that the books are in balance after all temporary accounts are closed. All right, so there's going to be another little quiz on Canvas, and it's going to be about closing entries and financial statements. And tomorrow we're going to talk about financial ratios and analysis, calculating metrics like gross profit and what that means, and what the gross profit margin is. And those are things that, maybe we just need to put on one sheet and also commit to memory. And so I'll try to get all of these things in your hands before the end of the week, so you'll have them over the weekend to prep on your own. And so that's all I have for today. And so it'll take you about maybe 10, 15 minutes or so to finish the quiz, and then you can work on whatever you need to work on.